All right, so we let the video upload quickly. All right, this is on Trump and the global economy, Trump and the G for short. I'm Shock Exchange here with Mr. Mitchell, of course. This is Trump and the G, Citadel, Gabe, Plotkin, Finesse, the Charlotte Hornets out of Michael Jordan. And we're going to ask people to subscribe to the channel and share and like the videos. We know people are listening, so we're going to ask people to subscribe and share the videos. But quickly with the economy, it's pretty much the same old on my end. The Fed is trying to fight inflation. We'll see. They've been intimating that they may keep hiking rates a couple more times this year. I doubt it. I think they're trying to tamp down the market, but the market keeps hitting new highs each week. Now as earnings are coming out, and some of these companies are showing strong earnings. So people, a lot of short sellers in the market are probably trying to cover right before earnings any potential good news. So the market's just steadily rising higher, which is the same story for the past decade, regardless of what the Fed does. I think I think the Fed is going to have to come to a realization or admit to the public that they can only do so much about inflation at this point, just like they can only do so much about deflation years ago by constantly cutting rates. So I think it's out of the Fed's control at this point. And it's still, stagnant to declining wages for the labor class. Still theft in these retailers where, those retailers that haven't closed pretty much have everything locked up. So people can't steal, which is a sign that the economy is not strong for a majority of the country. And then you have a drug overdose deaths still going through the roof. So people are in pain. Even after taking all the prescription opioids off the market, overdose deaths are still going up, and people are turning to the black market, which we've discussed previously. So I think the biggest impact on the economy could be the next election, whether a new president will try to come in and add more stimulus, whether it's tax cuts or what have you, to throw some chum in the water and sort of please the populace and maybe make good on certain campaign promises to spur the economy. But I think that's the only thing at this point that's going to change any trajectory is a new president coming in with more stimulus. That's sort of my take.
It's yeah, man. I mean, it's we see it every time we come on here. It feels like a broken record. It's earnings season again, like you noted, and it's kind of funny watching the markets bleed red. Although a lot of companies, especially in the first 2 weeks, the banks tend to lead. Lead earnings season, and I think in a large way tend to kind of give a signal as to what the rest of earnings season is going to look like for that particular quarter. The banks have kind of come out strong, but it seems like a lot of it was already baked in. Netflix and Tesla are kind of the two largest kind of tech companies that kicked it off. Quickly followed by IBM, all beat, all are showing kind of inline guidance, but it's funny because the market is yeah, we don't believe you. It's these overinflated valuations at this point. How much higher can Netflix go when they've already baked in 5 million new subscribers? They've cut off passwords. Tesla's already baked in increased production, rollout of now the Tesla truck. It's like how much more can these valuations continue to go when there's not a lot of room left? Although J.P. Morgan to B of A to Goldman continues to upgrade just in the last 2 months alone. Just those two companies, I think, along with Nvidia, seems like get a new upgrade every other day. and just continue to push and push. And it's like, where is this growth supposed to be coming from? Is it just supposed to trickle out of thin air? Or like, are we producing new human bodies that are contributing to the workforce, that are contributing to the GDP? Because kind of looking at the reality that AI is already taking up jobs. You're watching even startup companies lay off 50-60% of the labor force and trying to justify it because AI. And it's the new, not only buzzword, but it's the new justification. And as I've said the last time, we continue to cut at this rate, who's going to be left to continue contributing? It's only really what's known as blue collar that you cannot replace AI with. We still need welders, plumbers, engineers. We still need agriculturalists. We still need the builders and landscapers, folks that impact the building of the actual world. I think those are probably the safest jobs right now. But every other job that's predicated on intellectual capacity, there is no depth, corner, or reach that AI is not able to get into. So the long and short is, when you're undercutting the value of a labor force, what type of discretionary funds are left to continue buying Teslas and Netflix subscriptions and IBM products and Microsoft Office products, and essentially all of these products that are predicated on having extra. I think although a lot of these earning reports are touting strong earnings over the last quarter, I think all in all it's going to be short-lived. There is not much room left to go. S&P is already pumping, and we're hitting new highs in SPY, and it's like, how? Although we have a looming commercial real estate sector that's getting ready to just drop out, and there is not a bank in this country, at least not a commercial bank in this country, that doesn't have exposure to commercial loans and commercial real estate. So, I think that we're starting to see some of the correction come in place, although companies are touting strong futures. It's like, yeah, what Jay-Z say, we don't believe you. You need more people. That's really what it is.
Okay. So once this consumer goes, it could probably be a downward spiral for the economy, even though it may show up in the market with a lag effect. So basically, the show today is about Citadel and Melvin Capital, which was previously run by Gabe Plotkin, and how they finessed the Charlotte Hornets out of Michael Jordan. And I know it sounds kind of, it's a strange sort of title and a strange sort of topic, but what does Michael Jordan have to do with all this? We're going to get to later. But this is sort of a holdover from a previous show we had where we talked about GameStop and the short squeeze in the market in around January, February 2021, where, you saw these sort of struggling companies like GameStop, what GameStop has had, started out as, a pretty strong retailer and relied on consumers. Then they went to digital, where, people started playing games digitally and weren't necessarily coming in and buying games from GameStop, and it took them a while to make the transition. In the meantime, they had all these bricks and mortar stores and all these sophisticated employees, but what do you do with it when people are just buying games online and playing online and sort of bypassing the bricks and mortars? So maybe a large part of their inventory wasn't really being sold or being utilized. And it was one of several struggling companies, such as AMC and others, who these short sellers pounced on. And the moral of the story is, just because the company's struggling doesn't mean you should short it. It could die a slowing death, but it may not die it may not die immediately because it could have cash flow or be able to keep raising capital or stretch its payables to stay afloat. And some of these shorts had piled into these companies, and some of the short position were in excess of the actual shares outstanding, which is kind of weird. And nobody can figure out why certain of these struggling companies were trading so low. No matter what happened, they wouldn't rise because short sellers has just piled into it, and just kind of greed and avarice, where you can take a large amount of capital, short or long, and make a stock go parabolic in either direction. Particularly for maybe some of these thinly traded stocks, and as some of these stocks companies start to struggle, they become even more thinly traded because people lose interest in them. So GameStop was one of the companies that was basically the short position was almost equal to or more than the shares outstanding, and it was ripe for a short squeeze, and that's pretty much what happened. So I'll let Mr. Mitchell sort of explain the short squeeze in GameStop in a little more detail.
I mean, yeah, it's, at this point, it is just out and out manipulation. We've spoken on it. There was, the hearing that came out, and, we watched the power of kind of that collective push. It was certainly fun to watch. Let me say that. We were able to get a little bit of taste of the frenzy, and did personally watch Wall Street Bets, not hearing of it myself prior to the entire GameStop saga. I think maybe I caught wind maybe about a month and a half before the infamous spike and ultimate stop and rug pull by Robinhood and so many other broker dealers, but my peek into it was very short, so I can't say that I was a part of that climb. But in that short preview leading up, watch Wall Street Bets explode from I think at the time it was like 2 million. Or maybe even a little under 1 million subscribers, and I think it exploded up to like 9 million subscribers. Seemed like in just a week or a few weeks, it was just like massive growth, and the collective kind of unity that came along, and watching professional analysis. I think that was one of the kind of mischaracterizations that we saw floating around from mainstream media, Kramer, Squawk Box, and the like. Just kind of denigrating Wall Street Bets as these collective kind of noobs that had no idea what they were doing, and just kind of tripped and fell and lucked into this massive opportunity, and that couldn't be farther from the truth. I'm watching senior analyst level analysis was coming out of these threads, and folks pointing to the hows and whys they got to the conclusion, using same both fundamental and technical analysis, historical data. Again, senior level analysis, reports that were being pushed out throughout the community, and essentially crowdsourcing the validation. There was never this kind of ego-driven approach where here's my analysis, this is the end-all be-all. It was very much a sense of here's my analysis, please pick it apart, like tear this thing apart, find the weaknesses, and see how we can strengthen this analysis. And I think it was that approach that really drove this the kind of unification of Wall Street Bets during that early January and February months, and ultimately, they saw and rightfully called out just pure manipulation. we often hear. I think it was I'm going to blank on his last name. Michael Lewis, I think it is the author, The Big Short, wrote very loudly that the market is rigged. Right, just bluntly came out and said it. I think the kind of the opening of his book, The Big Short, and continue to parrot that idea that the market is rigged, and whether some folks believe that or not, some folks believe that the market is following a script. But the point is that the retail investor is largely at a disadvantage because the thing that we've said on this, even this show, numerous times, that once you find or pull a particular thread that you feel you've uncovered a particular tactic by Wall Street, you're missing the 12,000 other tactics that they have at hand. So, sure, you expose one particular lane, and that lane that was uncovered was synthetic shorts, and essentially the ability to short beyond the maximum shares available. We've talked about it even in relation to
Endo. Yeah, I know. Like, I wish I could forget myself. Actually,
Exactly. So the long and short is that this collective group, even if you say maybe only 10 or 20% of that 9 million subscribers to Wall Street bet was able to actually participate in the markets, were able to blow the shorts completely out of the water and squeeze them through, exposing their tactics to the world. And although they, the gentleman that ended up testifying and was kind of deemed the de facto leader of Wall Street bets,
the kitty guy.
Yeah,
Hello,
exactly.
hello kitty or something. I don't know.
It was I know, and I'm blanking on his username, but yeah, that's him, the kitty guy. He stated that it was not this us versus them mentality, but it very much was. And even if your intention is one thing, once it gets out into the public and the crowd, essentially that crowd will determine what it will be. So even though your intention is one thing, it is ultimately up to the people to decide what it will be for them. And it was very much an us versus them. So the more that the more that Citadel, the more that even
Melvin. Yeah.
Correct, yeah, because Citadel, ended up bailing Melvin Capital out, but it wasn't Melvin Capital alone. Even prior to, Melvin Capital was really kind of the face of this short squeeze, but there were many other hedge funds and prop firms that were participating in this short squeeze because it seemed like a no-brainer, and it seemed like a sure thing, because here was this company that was kind of a long since forgotten relic of the 80s, 90s, and early 2000s, and the landscape of the way that people gamed and engaged with finding out new games no longer required a GameStop. And, the company was bleeding, as you pointed out earlier. So I can't even say that looking at the balance sheet that shorting the company from a fundamental lens was wrong. I think that they were right to short the company because here was this company that was managing cash poorly, that didn't have any true prospects for growth. It looked like it was a fire sale. However, where I think shorts crossed the line was beginning to get into unethical practices and manipulation. Did this company need to be run into the ground on top of you shorting it. Shorting a company from $40 to $25, sure. But shorting a company from $40 to beyond zero, well, that's where, you are at this point beating a dead horse. And that's where the question becomes, where is the ethical lines drawn? And when does it just straight up become manipulation? When does it just straight up become vicious? And that's really the battle. That's really where that battle existed, was these shorts, and particularly Melvin Capital was looking to drive GME completely out of off of the board. He didn't want them to even have a chance to revive the company, and that was the issue. That you weren't simply looking at kind of a market a disjointment in price, and looking at taking a percentage to be able to take advantage of the arbitrage. You were looking to wipe this company completely off of the board. You were looking to take away employees. You were looking to force people into unemployment, and you were just looking at maximizing your profit opportunity at the sacrifice of the labor force that these folks still employ. And that's where I think the sentiment, people hate short sellers and why they have such a reputation that they have, but that's really what that short squeeze was about, beyond the numbers. That people understood that, because you are now pitting yourself against the very workers that have been exploited by corporations over and over again. And here's an opportunity, the one chance for them to get some payback back. And I still think that had Robinhood not pulled their had not pulled GME ability, or traders' ability to trade GME, both buying and selling, as we came to find out, because Robinhood was illiquid. They did not have the cash to pay the DTCC call from that morning. And as much as CEO continued to come out and obfuscate and just plainly lie, he lied to Congress. He lied in the Senate hearing. He lied to the public, and he continued to lie over and over again to say that Robinhood was flush with cash. No, you weren't. You could not afford to pay the bill that they were demanding, which means you didn't have the cash. Just plain and simple. If the bank is knocking on the door and saying the mortgage is due, your mortgage is $5,000, you got $4,500. Guess what? You're short. You don't have the cash, and that's what it is. And he was doing a lot of obfuscation, and because of that, they pulled and did something that was unprecedented. Most retail traders haven't seen that before, and I can say, even in my own career, that I've seen that very often. You typically see that type of activity in stocks that have been manipulated. You would typically see that in OTC, for example. You'll see that type of manipulation in OTC stocks, and these low cap or kind of micro cap penny stocks, where you can see, a stock running from, 25 cents, and, all of a sudden it's $200. And, it had, 50,000 shares traded, pretty low volume. And the manipulation tends to be very clear. And, the NAS will pull it. The NAS will halt that stock and yank it until it can prove that this was legitimate stock activity and trading activity, and not just market making manipulation. But this is a legitimate company. GME was a long time publicly traded company that still had employees. So this was not that, in other words. So this is the first time I've ever seen that type of action taken against a company that was being manipulated, but not by retail traders. Um,
This is also one of the reasons the Federal Reserve was set up to come in and bail out companies like Robinhood who couldn't, pay the bill.
yep,
But
exactly.
bailing out Robinhood also would have meant making retail investors whole and exactly more pain for these institutional short sellers who were very connected to the regulators. So even before it got to that, even before Robinhood said we're not going to on any more trades, we're going to sort of halt this buying and selling of GameStop. That the media was complaining about GameStop.
Correct.
They were when the media starts, mainstream media who doesn't even follow stocks start talking about stocks, something's amiss. And they were just talking about this GameStop saga and this GameStop meme. And then, even the financial press started complaining about it. Like, what are these guys doing? Like they were doing something nefarious. This is capitalism at its best. They saw the
Right.
market opportunity. The short sellers went beyond the fundamentals and just was trading on greed and avarice, and they were on the wrong end of a trade, and that's capitalism. That's how traders make money, and the corporate media were complaining about it. One guy from CNBC even asked a question during a Fed meeting. I think he asked Jerome Powell, what was he going to do about GameStop?
Right.
Like
Right.
like like these Reddit and these guys, these Wall Street bets were like almost like they were rigging the market, which is like
Right. Right. All of a sudden,
they were rigging it against the short
right.
sellers and against the institutions. So when Citadel Capital or Melvin Capital or whomever, these private equity firms and hedge fund managers, when they make a mint, they're just smart traders, and you
Yep.
shouldn't be, you should and they were exacting pain on a lot of retail investors. GameStop wasn't the only one. They were also exacting pain on Indo, shorting Indo, COS, AMC, other stocks as well. They were just basically piling into these stocks and exacting pain because they had more capital than individual investors. And they had more power than individual investors. They were making wrong bets, but when you have more capital than everybody else, you can last longer than a typical individual. And so, to make a long story short, I never seen someone in CNBC. Why does he care about in trade? He was clearly protecting his clients, whether it was investment banks who were counterparties to these hedge fund managers, or protecting the hedge fund managers directly. He's asking Jerome Powell, what's he going to do about GameStop? Like the Federal Reserve supposed to step in, and when hedge fund managers make a lot of money, it's great. When they lose, we got to do something about it. And then you had the regulators step in. You had Elizabeth Warren asking questions. You had people connected to the market asking questions, and it basically was implying that the system is fragile. What they really meant is that if Melvin Capital, Citadel, and other hedge fund managers go under, it's going to create these retrocessions where a counterparty risk for Goldman Sachs or Morgan Stanley, if they can't pay Morgan Stanley and Goldman Sachs, Goldman Sachs and Morgan Stanley or Interactive Brokers, whoever can't pay their counterparties, and it creates a domino effect to the system. So the system is fragile. When hedge fund managers lose money, that's the excuse. But when they
Yep.
make money, it's all good. And so I'd never quite seen anything like that. They could have easily, the Federal Reserve could have easily made Robinhood whole and honored those trades, which they should have on a capitalist system, but in a foul capitalist system or synthetic capitalist system where it's capitalist unless someone donors or someone connected to the government loses money, then all of a sudden it's socialism. So
And that's
that seemed to be the message of the whole saga, and I think uh, made the U.S. look bad, made these individual investors who some of them were novices to the market. It left a sour taste in their mouth. Like this system is rigged. We can't win.
no, that's literally one of the phenomenons that was interesting to watch, where all of a sudden retail was being treated as if they had the tools to manipulate the market. It was so funny to kind of watch because every day, I was on Reddit for hours every day during this saga, and every mention of Wall Street bets would get kind of repurposed onto Reddit and brought up. So every time Kramer or Squawk Box or any of these other talking heads would talk about Wall Street bets, even if you missed it kind of live, it was put into it was put up on the Reddit, and one of the things that was kind of a running joke was that retail traders have two tools, really one, but you can do two things with it. You can buy and you can sell. That's it. You can't have like retail traders are walking around with Bloomberg terminals at home, and but all of a sudden they're being demonized as if they were the ones that were manipulating the market, as if they had this insider information and was trading on this insider information that the most sophisticated institutions didn't have access to. And it was
it was like that. It was like the guy who was hitting Wall Street best with Rasputin or something.
Right.
You can't do that. He's cheating.
And they turned this man straight up into Machiavelli. Over there, like all of a sudden, this man became the greatest villain in the history of villains.
He was like worse than Gordon Gekko.
Right. It was like Lucifer and then Hello Kitty. Like that was
That's how you know. That's how you knew who were losing money. It was somebody's friends with the Federal Reserve or CNBC were losing money.
Like, come on! Like this is the guy. This is the guy that was responsible for the 2008-2009 financial crisis. He was the one cutting checks to the billionaire hedge fund.
This is William. I was expecting someone 10 feet tall and shooting rockets out, shooting lightning out of his hands or something. Yeah,
exactly. Right.
This is the guy. Okay.
Right. It was definitely the collateral damage that you didn't see coming. That was not on my bingo card. The retail traders would get demonized and essentially treated as like you would think it was 9 million Bernie Madoffs. Like that's essentially how mainstream media was talking about Wall Street bets. But and really kind of the long and short is that it certainly revealed not only how fragile the system is, but that the part the media plays. So it told you in a very roundabout way that the media is intentionally complicit. They understand that this system is fragile. They understand that the words that they are putting out over airways on a daily basis, when it comes to the investor confidence and keeping investor confidence, they understand their role better than I think we give them credit for. They had to demonize Wall Street bets in order to keep investor confidence, because they understand that this system is very fragile.
Well, the other thing, they were speaking to the Fed, too. So when the media keeps repeating something over and over again, say, well, the Fed needs to do something, step in, over and over and over again, it gives the Fed cover. Just step in, do something that's not not based on capitalism.
Right.
And then you keep repeating over and over again, and when the Fed reacts, it's already put out there into the universe that that's the Fed's doing its job. Because they keep repeating it. So the dog whistle to the Fed, come in and help our clients, or come in and help our advertisers, people who advertise on CNBC, whether it's Morgan Stanley or Goldman Sachs or Interactive Brokers. The Fed needs to step in and do something. The other thing that people like Zero Hedge were kept putting up this report card, because we knew somebody was losing money, we didn't know quite who, and then they started putting up a couple every other day, putting up like a log of who lost money today or this week.
Correct.
And the list of hedge funds on there, how much they were losing was crazy. And one was obviously Melvin Capital. And what ended up happening when the Fed stepped in and told and the politicians stepped in, whether I think it was Elizabeth Warren stepped in, and they basically said halted trading on Robinhood. It allowed to stop the bleeding for Melvin Capital and others, probably even Citadel, because Citadel had a position in Melvin Capital. I think they gave Melvin Capital more money to make to help make Melvin Capital whole, at least stop the bleeding. I think Melvin Capital kept shorting stocks and then ended up shutting its doors maybe a year later. But there was something came across my screen back in March that around that time that Michael Jordan was down $500 million. I didn't really pay much attention to it because I couldn't really. It just seemed like okay, I don't have time to even parse through this stuff because it also wasn't. There also wasn't a lot of information about it. Just all we know is Michael Jordan was down $500 million, and so now so a couple weeks ago he sold a majority stake in the Charlotte Hornets to Gabe Plotkin, who used to run Melvin Capital, which gives me the impression that Melvin Capital, the bleeding stopped at Melvin Capital, and the bleeding stopped at Citadel and some of its portfolio companies. I think they had an investment in Melvin Capital. However, Melvin Capital's clients weren't made whole. So somehow, I guess that's called a hustle math, where you bail me out, but we pick and choose who gets made whole. And obviously, the black guy, Michael Jordan, wasn't made whole. And so what we found out later is that Michael Jordan didn't really have $500 million invested in Melvin Capital. He had borrowed the money. He didn't put $500 million in cash. He had borrowed the money on credit, which also kind of shows you that when you look at the short sellers, you're kind of looking at the tip of the iceberg. When we're buying Indo, and we're trying to get investors to buy Indo and to create a short squeeze, we're not just fighting against short sellers. We're fighting against people like Michael Jordan we're not fighting against capital, we're fighting against people who don't have the capital but have the credit, who are basically investing money they don't have. And there's no way you can beat these guys. And so it gives the impression that, I guess the way it works out, that Michael Jordan may not have had a wealth crisis because he had enough assets to cover $500 million. He probably had a liquidity crisis. He didn't probably have $500 million in cash. And I saw rumors that he was getting like maybe $100 million in revenue from Nike for the shoe company for his shoe, the Air Jordan. Correct. However, if you think about the interest rate on that $500 million, because we can look at the cost of capital for the short sellers, that it was going through the roof with GameStop. I'm just guessing. Let's say, for instance, if Gabe Plotkin was charging Jordan 30% interest on $500 million. That's $150 million a year. So he probably had to sell assets. I heard something on Reddit. He was selling his NASCAR assets, selling some houses. He's probably having to sell assets just to cover the interest on the $500 million that he owed. And so so he probably had a liquidity crisis, not necessarily a capital crisis, but he probably had to do something quickly, or that, again, that $500 million is going to rise to 600, 700, 800, maybe even $1 billion pretty quickly at 25-30% interest rates, I'm guessing, at those rates. So he may have had to sell the team or sell a stake in the team because he didn't have liquidity, and he definitely couldn't cover the VIG or the capital cost on the $500 million.
Right. Well, it was interesting to watch the evolution, because if you recall, when this was first announced that Jordan was selling his stake in the Hornets, a lot of folks were applauding Jordan and giving him, his kudos for making a savvy move, buying it at, $300 million and, turning around and selling it for $2.1 billion. That's a heck of a return, etc. And on the surface, it seems this does seem very savvy until you realize that Jordan was the pig, and he's the one that got poked, and that's where it quickly soured from applause and kudos to being a savvy investor. Kind of seeing the landscape down the road to realizing you just got finessed, and you got finessed by folks that you arguably call friends, not realizing that one of the co-owners of the Hornets was also friends with Ken Griffin of Citadel. And it was, and to my understanding, this is how Jordan was even made aware of Plotkin and the game and the GameStop opportunity in the first place. That this is not Jordan's wheelhouse of typically having large exposure to short selling within the market, but he was brought in to this opportunity. Apparently, was not liquid at the time, but essentially got a credit against his earnings with Nike, which is about call it somewhere between 100 and 150 million annually. So essentially you're doing about 5 years, kind of 3 to 5 years worth of your future earnings to be able to participate. And watching and kind of looking at this, you begin to quickly understand that just that decision right there, like the moment he said, "Yeah, let's do it," was the moment he lost the Hornets. And it's hard to refute that was the intention in the first place. That this was potentially a plot to get Jordan off of his position and to ultimately scoop up that asset and to scoop it up on the cheap. As you watch Ken Griffin, which didn't make sense, that Citadel and even Interactive Brokers, Peter Schiff, that was if you kind of look back, because I even brought it up on the show when we were covering the GameStop saga initially, that one of the things that I found interesting is that you don't typically see Peter Schiff in the news very often. He's not a talking head. You don't really hear him giving his opinion either one way or the other. When it comes to broader economic news landscape, he's not a consistent talking head on CNBC or any other financial news outlets. He tends to be very selective. So to see Schiff come out and specifically support and publicly support Melvin Capital, and to help kind of make Melvin Capital whole again, I thought was really strange, to be very honest. Like I thought it was strange to see such an aggressive move because the numbers just didn't add up. It didn't hold up that Citadel, along with Interactive Brokers, would be cutting a check. I think it was $6 billion at the time, maybe a little more, and only to end up losing it 48 hours later, the entire $6 billion. And the fact that again, I think I said it maybe in our own conversations, but I said this guy that just lost over $10 billion during the Senate hearing, he was way too calm. This guy was way too calm for a guy that owes billions of dollars to investors.
You talking about Melvin?
Yes, I'm talking about
right.
Melvin Capital. He was way
he didn't look right. He
during
didn't look
that Senate hearing. I'm like, this is a guy that is unsure of his position.
Yeah, there was definitely a disconnect because the numbers that Zero Hedge were throwing around, and then I didn't see anybody jumping off a building. You know
exactly.
What I mean?
You didn't see anybody.
This is why the Federal Reserve was set up to begin with, because back in, let's say, the early 1900s, right? You'd have John Pierpont Morgan. He's the bad cat, right?
Yep.
And so my bank's in trouble. So I have to go to John Pierpont Morgan and the other guys, other big bankers, to pass the hat around to bail me out, because it could fall back on everybody. So
Right.
everybody can have, it's going to have a domino effect or a retro session where everybody gets affected. And J.P. Morgan would take his pound of flesh. To bail
Right.
him out, he'll pick, but it was also ad hoc. Sometimes he could say, no, I can't bail you out.
Right.
I can't bail you out this time. Well, I can't
Yeah.
bail this guy out. Sometimes he bail people out, and sometimes I can't do it. So it's ad hoc
Yep. Yeah. Yeah.
based on the particulars of John Pierpont Morgan. So this seems like it was ad hoc, where there's a lawsuit to be had, and we're going to Melvin Capital's going to take some of the loss. Citadel's going to take some of the loss. This hedge fund manager, their hedge fund manager, but Jordan's going to take the 100% of the loss. So they decide who gets the loss and who doesn't. That's what it sounds like.
Right.
It sounds
No,
like
and that's-
ad hoc of all the people who had put exposure to GameStop shorts. Michael Jordan's going to take 100% of the loss, and that's ad hoc.
Right. So the interesting part too is that, and just to be clear, I think Jordan was simply collateral damage. But the interesting part is that that Ken Griffin covered the friend, the co-owner, the Russian co-owner, who essentially made the credit with Jordan. So you have Griffin that supposedly lost out. You had the co-owner that brought Jordan in that lost out. But the co-owner and Griffin are being made whole, and Jordan's the one left holding the bag. And I'm certain that there are others along with Jordan. But this certainly seems like, a very Othello-esque plot.
Right. Because the other thing is that he's not just selling a stake in an asset. He's selling a stake in an asset that he'll never get back, because you can't go out not like a McDonald's franchise where you can go out and build a McDonald's franchise across the street or another town. The NBA is not letting you start another basketball team, and you can only get into the network unless somebody sells you a franchise.
Correct.
And so it's an asset that maybe what comes along once every 20 years, and the more
Yep.
and now they come along every time it comes along. Now the value is going to be 6, 7, 8. It's always going to go up 8, 10, 9. Because now the NBA is letting sovereign wealth funds buy into the league. So now you're going to be competing against sovereign wealth funds. But I mean, I saw the movie Goodfellas. Maybe Michael Jordan didn't see the movie Goodfellas, where the restaurant owner is saying that these guys are like not paying their bills, and they go to Paul and say, "Will you make an investment into the restaurant?" But when he makes an investment into the restaurant, not knowing that that's Paul's restaurant now.
Yep, that's it. That's literally it. So Jordan got finessed out of his position, and I think he was just collateral damage in it, but it's certainly in terms of collateral damage in the sense of I don't think the opportunity of GameStop specifically targeted Jordan, and they found this opportunity in order to move Jordan out of his position. But here was an opportunity where, his quote unquote friends saw a way to potentially get him out of his position, especially if if these folks are using a bit of game theory, right? Or it's like, okay, well, you cough up 500 million that you don't have. Best case scenario is that this works well. Let's say you make 20%, 30% on your money, which is a huge return. You get back 20 or 30% of what you actually put in, into it, which would be still less than 500 million, and you get to keep your position. You put a couple $100 million in your pocket, and you kind of go on your merry way until the next go round. But if Jordan would have looked at the downside, like what is my risk here, that I'm already over leveraged against my entire cash flow. What do I have to lose here? And I think if he would have done some of that analysis, or at least the people around him, I mean, you got to assume that Jordan has advisors. Uh, at least you hope so. And folks that he can call and say, hey, here's an idea, here's an opportunity. Like, I want to run this by you. Tell me what you're thinking. What do you see? You crush the numbers. Give me the analysis. And hopefully there was at least somebody that was in his ear and was like, hey, this sounds great, but this really doesn't make a lot of sense. You're over leveraged here, and this is an IOU. And if you lose this, they're going to recall this IOU. There's no way, there's no way around it. It's like, sure, the Fed is cutting checks, but you aren't an institution, Jordan. You're a bit like, you don't even make the Forbes 100 list. You are barely a billionaire, and that's from total. That's from total net worth, that you are in billionaire status, but you are not a liquid billionaire. You are 100 millionaire. You're doing very well, but in other words, you are not on the same level as the institutions that the Fed is cutting checks to of $80 billion a month. So if you lose this, in other words, how do you regain it? You're looking at another 10 years of shoe sales and continued contracts in order for you to recoup what you have already lost. And that's exactly what has happened. So you hope that there was somebody in Jordan's ear saying that, and he just said, you know what, I'm going to still do it anyway. But, if he didn't, either way, he made the decision to do it, and he simply got finessed. He played with the big boys and realized that there was a bigger game afoot, and that you're still Michael Jordan at the end of the day, but unfortunately, you were playing with the bigger owners. I think they allowed that to get to his head. Oh, I'm an owner now.
There's no way Jordan could have seen the finesse. There's no way he could have seen it.
Yeah.
He could have seen it is because he's been finessed before. We know he gets finessed because we're not telling the whole story. We're telling Jordan's story. We're not telling our story. We're telling Jordan's story. I'll leave it at that. But I'll stick with the Goodfellas analogy. All right. But you can see the finesse coming. And then you got to pay the vig on the $500 million. You can't afford it.
Yep.
You know what I mean? And now, and you're talking about like it just, and they put out these press releases about how Jordan he made all this money, whatever. He wasn't anybody at Charlotte Hornets to get a quick return. I can guarantee you that he wanted to be a long-term holder. He could probably pass it down to his kids or grandkids or what have you, because it's an asset you can't get back. He probably dreamed to become an owner, just like LeBron James dreamed to become an owner. And I think this could probably change Jordan's GOAT status, in my opinion. If LeBron James become an NBA owner and Jordan lost the Charlotte Hornets, or get finessed out of the Charlotte Hornets, I think you gotta put I think he loses the GOAT status. I mean, I know he's a great player and all that, and he's one of my favorite players. But this is like you become an owner. Black folks push for African Americans to become owners.
Yep.
And you become an owner, and this is what you do.
I think his best shot at this point is to grab either an MLS team or a football team overseas. It seems like it's the latest craze amongst high net worth individuals is getting exposure, and a larger percentage, 5, 6, even 10% of a football team. Ryan Reynolds has done it. You watched even Russell Wilson do it. I believe they started an MLS team and also purchased an interest in an established European League or English Premier League football team. So maybe I think maybe that's his his best opportunity to get back on that owner list. But I think there are very few teams that are still showing opportunities, even in the hundreds of millions, uh,
Right.
this far into the future. Um, it is
Yeah,
it's heartbreaking almost when you think about the fact that, like you said, he probably thought this was going to be his legacy to be able to pass down, even 5, 6 generations from now. This was true generational wealth that he was able to pass down to his grandchildren and great grandchildren. That he lives long enough will probably get an opportunity to actually see. But it's almost heartbreaking. You almost feel bad for the guy. But yeah, Jordan just got straight up finessed, and you can't even, as competitive as Jordan is, I think he can probably only respect the move, because even the friend that brought him in, who supposedly went in bigger, supposedly he put in $1 billion, which is what I'm sure is what made Jordan feel comfortable. Like, hey, here's this guy putting in more than what I'm putting in. Let me come in at a fraction of what this guy is putting in. But when you're rubbing shoulders with folks that have your entire annual revenue just sitting, sitting in accounts for them. When it's one thing if you're earning $100 million a year, it's another thing to be able to pay someone $100 million a year. And Jordan was still at that level.
man,
And I think he just got. I think he got caught up in the fact that he rubs elbows with folks that can pay people hundreds of millions of dollars a year, versus the fact that he's earning $100 million a year.
I mean, I understand the analysis and all that, but the finesse was in.
Oh
If it
yeah,
was, if it wasn't that deal, it'd been something else. But I don't think people just. It doesn't happen where just no. It's not an accident. You get somebody that you borrow $500 million, and next thing you know, they're asking for your company for your basketball team, and it doesn't
right,
seem like that sale was arm's length either. I don't remember any auction process.
right, right,
You know what I'm
right.
saying? It doesn't seem
Yep.
like it was arm's length. I can guarantee you, if Melvin Capital sells it, it's not gonna be it's not gonna be for $3 billion. It's gonna be much higher.
Oh yeah,
And they're
he's
gonna
probably.
seek an auction process. He really has an asset that's probably really worth over $4 billion.
Yeah, he's definitely gonna Martin Shkreli this thing. Like, he's gonna try to squeeze out every bit of value uh, out of this. And you can't even blame him. Like you can't, you can't even blame him. Although the finesse went in place, um, but he's going to be patted on the back. He's going to be ushered into kind of the upper echelons of the savviest investors. And he's going to be remembered as a person that crashed and burned and, still rose out like a phoenix. And I'm sure that, in between those two events, that there's going to be some pages filled with how he bootstrapped and struggled and fought his way back and a triumphant story of true capitalism and the true engineers of the future. So I'm
Right.
sure that's how that story is going to be written.
Right.
So,
Right.
yeah.
Okay. So that's Trump and the GE, Citadel, Gabe, Plotkin, Finesse, Hornets on Michael Jordan. And it seems like after LeBron James and Clutch Sports see the show, they're gonna add another argument to the GOAT status. But anyway, so we're out, and we'll see you in a couple weeks. Thank you.